Hey there everyone, we are thrilled to have you back at our channel, The Elite Economizer. Today we're diving deep into the world of wealth building, discussing the 3 essential pillars that can pave your way to financial freedom. After all, isn't that what we're all after? Freedom from financial worries? Pillar 1. Investing in real estate for income. Let's kick things off with the first pillar, investing in real estate for income. When we think about passive investments that generate income, the stock market often comes to mind. You might buy shares in a dividend-paying company like McDonald's and eagerly await those quarterly dividend checks. However, today, I want to tell you why I favor real estate over stocks when it comes to generating passive cash flow. Real estate is a powerful asset class because it can offer consistent rental income. Imagine you purchase a property, be it a house, an apartment building, or a mixed-use development. You lease it out to tenants, and in return, they pay you rent each month. Let's take a simple example. You buy a house and rent it out for $1,500 per month. That's $1,500 of passive income in your pocket every month. The beauty of real estate is that, if done right, it can cover all the property-related expenses like taxes, insurance, maintenance, and management fees, leaving you with a tidy profit. In many cases, you can even hire a property management company to handle the day-to-day tasks, making real estate investing relatively passive. Tax advantages in real estate. Now, here's where real estate shines even brighter. Tax breaks. The IRS offers some of the most substantial tax breaks to real estate investors. Let me illustrate. Suppose you're making $1,500 per month in rental income, and your monthly expenses, including mortgage, maintenance, and others, amount to $1,000. This leaves you with a $500 monthly profit or $6,000 annually. Here's the fantastic part. You don't have to pay taxes on the entire $6,000. Thanks to depreciation, you can tell the IRS that your property is getting older each year. For example, if your property was worth $170,000, you might claim a $5,500 depreciation expense. This means you only pay taxes on $500 of your annual profit. Real estate investors love this because it allows them to legally pay next to nothing in taxes while building their wealth through rental income. But wait, there's more. If your property appreciates in value over the years, you can sell it. The IRS lets you do a 1031 exchange where you can reinvest the proceeds into a larger property and defer paying taxes on your gains. It's a powerful wealth-building tool that keeps your money working for you. Choosing the right real estate investments. Now let's talk about choosing the right real estate investments. Residential real estate, like single-family homes and apartment complexes, is a favorite because it's innovation-proof. People will always need a place to live, regardless of the digital transformations happening around us. While retail and office real estate face shifts due to e-commerce and remote work trends, residential real estate remains a stable choice. When selecting properties, consider factors like location, population growth, and demand. Aim for areas with low crime rates and high desirability. My strategy is to look for properties that provide a 7% cash-on-cash return. For every dollar I invest, I aim to make 7 cents in positive cash flow annually. This approach ensures consistent income. Remember, while property values may fluctuate, my primary goal with real estate is generating cash flow. So if values drop, I see it as an opportunity to buy more properties and increase my cash flow. Pillar 2. Investing in businesses for growth. Now, let's move on to the second pillar, investing in businesses for growth. Unlike real estate, where the primary aim is income, here we seek growth in our wealth. When you invest in businesses, you're participating in their journey to create more value, generate revenue, and make a profit. Investing in publicly traded stocks. One of the least risky ways to invest in businesses is through publicly traded stocks. You can buy shares in established companies listed on the stock market. Think about it. You become a partial owner of the company. Companies on the stock market are often worth billions of dollars and provide a degree of stability. However, they're not immune to market fluctuations. You can take a hands-on approach, researching and selecting individual companies, or adopt a passive strategy by investing in exchange-traded funds, ETFs. ETFs offer diversified exposure to a basket of companies, reducing the risk associated with individual stock picks. Investing in startups. Venturing into startups is a bit riskier but can yield higher rewards. Startups are typically smaller companies striving to secure market share and grow. By investing in startups, you're providing them with capital to innovate, hire more employees, and expand their offerings. Several online platforms like WeFunder and Republic enable you to invest in startups. Keep in mind that while the potential for significant returns exists, startups also carry a higher risk of failure. Investing in your own business. Investing in your own business is a unique opportunity. As an entrepreneur, you're investing in yourself. However, entrepreneurship is not for everyone. It demands discipline, creativity, and the ability to navigate the challenges that come with building a business. Building equity in businesses. Regardless of the method you choose, investing in businesses allows you to build equity. As the business grows and becomes more profitable, the value of your investment increases. If you invested $10,000 in a startup and it becomes $1 million company, your $10,000 investment could be worth a significant sum. Pillar 3. Diversification for stability. The third pillar is diversification for stability. Diversification is the concept of spreading your investments across different asset classes to reduce risk. It's like not putting all your eggs in one basket. The goal is to create a balanced portfolio that can weather market fluctuations. Asset classes for diversification. Diversification doesn't mean solely investing in real estate and businesses. You can further diversify by including other asset classes like bonds, commodities, and precious metals. Each asset class has its own risk and return profile, and they don't all move in the same direction. This means when one asset class is down, another might be up, helping to stabilize your overall portfolio. Risk tolerance and time horizon. Your risk tolerance and time horizon play a significant role in diversification. If you're young and have a long time horizon, you might be comfortable with more aggressive investments. However, if you're nearing retirement, you might opt for a more conservative approach to protect your wealth. Achieving financial freedom. In conclusion, wealth building involves these 3 pillars: real estate for income, businesses for growth, and diversification for stability. Each pillar serves a specific purpose in your financial journey. Real estate generates passive income, provides tax advantages, and builds wealth over time. Investing in businesses offers growth potential and equity-building opportunities. Diversification across asset classes helps protect your wealth from market volatility. As you embark on your wealth-building journey, remember that there's no one-size-fits-all approach. Your financial goals, risk tolerance, and time horizon will determine how you allocate your resources among these 3 pillars. The key is to stay informed, continuously learn, and adapt your strategy as your circumstances evolve. Thank you for joining me today. If you found this information valuable, please like and subscribe to my channel for more insights on wealth building and financial freedom. And as always, remember that building wealth is a marathon, not a sprint. Stay patient, stay focused, and you'll reach your financial goals.